Mr. Nitesh, right at the end there. Mr. Nitesh is a very experienced financial markets. He co-founded what's called iRage Capital Advisory, based in Singapore, doing HFT. He has been he graduated from Kanpur IIT, a very prestigious institution in India, and he did his postgraduate study in management in IIM Lucknow. So can I invite Mr. Nitesh? Thank you very much.
All right. Hello, everyone. Very good morning to you all. First of all, I would like to thank Bursa Malaysia for inviting us for this session. And I'm pleased that all of you are here to actually learn a bit more about futures and options and derivatives, how to trade them, how to trade using hedge using them or trade using them. So before we start, can I have a quick question that how many of you already trade into futures and options? Okay, a few, which is good. And others, I believe, are into trading, but maybe physical side or some other part of the trading business. So, okay. So, then what we will do is that we will keep the session more basic in terms of understanding the concepts of futures and options, and then also try to go about a bit on the various trading strategies which are possible in using futures. So my session will be on futures, which will be followed by, as Jeffrey said, by a session on options taken by Rajiv. Okay, so to start, so this would be the agenda. First would be, we'll go through the definition of what are the futures, then the fundamentals, then the pricing, how do we price futures, and how do we model different strategies, and then, of course, the strategy part. All right. So, the definition. So, first of all, before we go into future is kind of a derivative, rather a financial derivative. So, what is a financial derivative? A financial derivative is a financial instrument whose price is based on the price of some other underlying. That indeed is also a financial instrument. But that is not really the broad definition of derivatives, because the derivatives can have their underlying as anything. It can be like, there are weather derivatives which are based on what are the weather forecast. There are obviously in commodities, in financial markets, you have derivatives for all sort of things. Credit default swaps, which you saw probably a few years back in limelight. So there are different kind of derivatives, but our focus today would be more on the financial derivatives, which would include on equity, equities and indexes, commodities, and futures and options for the same. So a future is basically a financial instrument whose price is based on, in case of say equity future, whose price is based on the stock, cash stock, or the equity in case of a index future, equity index. So in Bursa Malaysia, say for example, you have FKLI, right? So which is the index, stock market index over here. So you have futures based on that. So a future will have its, basically there will always a buyer and seller, and a buyer is actually buying it from the seller for a particular date, an expiry date, sometime in future, and the settlement will be happening on the expiry date itself. Okay, futures are always on the exchanges and traded on the exchanges, and they are standardized contracts. So what is standardized, we'll be seeing that in few slides. But the counterpart for futures is forwards, so which is on the over-the-counter market. So say in the banks, offered by the banks, or say two independent counterparties, you can go ahead and actually have a forward transaction between, say, I can go and have with him a forward transaction where we agree on the various terms for settlement and for the pricing. But in case of exchanges, it would be all things are standardized, and that is called future. Okay. So what are the various market participants who benefit from trading in futures? First one is, of course, hedgers. Like if some of you, I believe, would be in physical trading. So when you're trading, say if you are a jeweler and you are into creating jewelry and you are buying gold and then doing whatever operations on it and creating some jewelry out of it. So when you buy gold and while it's in your factory and you are making it into jewelry, in earrings or nose rings or whatever, at that point of time, if the gold price goes up or down, that will have an impact on what price you can sell your jewelry on when the product is made, right? So for that, you are open to a risk. You're open to a risk that in case the prices go down, you have already bought gold at say $2,000 per ounce, okay, or say $1,500 per ounce. And if the price goes down to $1,200 in 3 months' time while your product is getting ready, then when you go and sell it, you will probably be not able to sell at the profit at a profit, because 1,200 plus whatever your cost of manufacturing plus your profit margins, it will still be probably less than 1,500, right? So in that case, what you can do is that you can hedge yourself by participating in the future market. So you go and buy the futures, and in case the price goes up, the price of the future also goes up. So that way your loss is being compensated there. Okay, so that is one kind of a market participant. So who are there in the market primarily to hedge their positions, which they have open elsewhere. Okay, second would be your arbitrageurs. So arbitrageurs, they are the guys who are there to make a profit out of the differences between the prices. So same instrument, say, is being traded, say gold FGLD you have in Bursa Malaysia derivatives, and you also have GC, that is gold contract in CME. So in case both have similar kind of settlement terms, both have similar kind of quality levels, everything is same, in that case you will, if the prices at CME goes up and the Bursa Malaysia derivatives is going down, in that case you can go and arbitrage between the prices, right? So you can probably buy at Bursa Malaysia, sell at CME. So that is what arbitrageurs do. They buy at a place where it is cheaper and sell where it is more costlier. The same thing, more or less the same thing. Okay, so so they play a very major role in maintaining the correlation between the markets, between various exchanges, because this way, since the arbitrages are present, you will it will ensure that the prices are not going haywire between at Bursa Malaysia versus CME. Both will move in tandem to each other. Okay, so so that would be arbitrageurs, and then you have the third category, which is called the speculators. So speculators would be guys who don't have any exposure as such, or they don't have any motive of arbitraging or hedging, but they just are taking a punt on the prices. That okay, they believe that the gold prices are expected to go up in the near future, so that's why they will go and buy, and they will sell when it is going low. Okay, so sorry, sell when it goes up. So that's the role of the speculators. As the name suggests, they are into speculation. Okay. Yeah, sure. So then, so I hope, in case if there are any queries in the middle, we do have a Q&A session at the end of the program, but still I would be happy to take any queries in between. So okay, so so key characteristics. So key characteristics for the futures, first would be the spot price. So what is the spot price? So spot price is the underlying instrument price. So in case of gold, the underlying instrument is the physical gold, the actual gold which is getting traded in the physical market. In case of an index, say FKLI, the underlying instrument would be your KLI index, as in the stock index. In case of an equity future, it would have been a stock future, it would have been your cash stock. So whatever price the cash stock is trading at. So that is your spot price, okay? Then you have the contract or the lot size. So contract sizes, in case of equity markets, cash markets, you see that you can buy one share, sell one share, right? But in case of futures, you typically operate in terms of lots. So you might have, say, a lot size of 50. So which means that the future is contains 50 shares on its own in the contract. And if you want to buy one lot, if you want to trade a future, you will have to trade in terms of lots, lot sizes, which means that if I'm buying one future contract, that is equivalent to buying 50 stock indexes, cash stock. Okay, so it can vary. Obviously, it varies from commodity to commodity, stock to stock, asset to asset, but every future will have a particular lot size for it. Then the expiry date. So the expiry date is the date on which the contract expires. So what do we mean by contract expiring? So say if I want to buy a gold future today, and the gold future will be, say, is it of March expiry or say of May expiry, May 2015 expiry. So that means that the future would be expiring on the last date or middle month, whatever the exchange convention is. So it will be expiring on a particular date in the month of May 2015. So it will cease to exist after that, and all the settlement will be happening on the expiry date, okay, or around the expiry date, whatever the settlement rules are based on that. So that's so if till the time the contract expires, your P&L is just the MTM. It's still not converted to a profit or a loss until you offset your trade. Okay, all right. So so expiry date, after that is your settlement. So settlement can be, there are two major settlements which are prevalent in the markets, both in the OTC as well as in the exchanges. One is your net settlement or cash settlement. So what happens in case of a cash settlement is that whatever is the difference on the expiry. So if say I bought a gold future at 1450 today for the month of May expiry, and on expiry it is at 1472. So what the settlement would be just for those $22. So I'll be getting $22 from the exchange or from the clearing party, and I do not need to pay anything further beyond that, or exchange do not need to pay or deliver anything beyond that to me. But in case of a gross settlement, which is the second kind of settlement, what happens is that you have to actually pay 1450 and exchange has to pay back 1472. All right, so it's not just in case if you do not have enough money to pay, then you might be in trouble, even though you are in a profit-making position. Then the margin. So margin is a very interesting part of futures, because you say if the gold contract is for 100 ounces and the gold price is at $1,500, that means that your contract size is 1,500 into 100, which is $150,000, right? So $150,000 you want to buy or sell that one lot. So do you need to pay the whole $150,000? $150,000? Probably not, because exchanges come up with the margin rates, that what is the margin required for this particular asset class or this particular instrument, based on the volatility, based on the price movement or the expectation in volatility, and based on that they would provide you that, okay, you need to pay 8% or 10% of the margin as margin for trading this instrument. So in that case, for $150,000, if the margin is 8%, you just need to maintain $12,000 with your clearing party or with the exchange, and that should do. So you do not need to put in the complete money. So which is good in terms of the amount of position that you can take for the same amount of money, but not so good in terms of the risk that the clearing house faces. So like we saw very recently in case of Swiss franc, when within very few seconds, in a few seconds time, you had a movement of 10%, 20%, and while the margin was like 2%, 4% at the max. So so in case of extreme movements, this becomes a major issue for the clearing houses, and of course for the traders as well, because ultimately you are liable to pay to the clearing house. So yeah, so that's margin, and then you in the margin you have various kind of margins: initial margins, maintenance margins, variation margins. But those are different things from the perspective of how much margin you need to pay to initiate a position, to maintain a position, as in to carry a position, and the variation margin is typically based on the volatility, how much volatile it is. Then one of the last key characteristic of futures is the delivery. So some of the contracts might be deliverable, some might not be deliverable. Good case in point would be, for example, the index futures. They are, in most of the cases, they are not deliverable because there is nothing called index as such. It's just a number. It's not a real asset, so which you can deliver or take delivery or give delivery of. So, but in case of commodity futures or stock futures, they can be deliverable. So what delivery means is that on expiry, to settle the position, you have to actually make the physical delivery of the underlying asset. Okay, so so when we say that you have to make the delivery of the underlying asset, what we mean is that the exchange would provide you with a list of parameters that, okay, this is the quality that we'll accept. So what is the, say in case of gold, what is the purity level, how many carats, what kind of gold, then you will also have the position, the places where you can actually deliver, the warehouses. So it is not like you can go and dump it in the office of Bursa Malaysia, right? So there would be warehouses and there are assayers there. So who assay the position, that who certify that this is a good quality or not. So accordingly you deliver, and the person who has bought has to take the delivery. One more interesting part is that in case of from the perspective of actual trading, you don't really, most of the people do not want to give or take delivery. Otherwise they would have been in the physical market mostly, but especially the speculators. So what they want to do is that they want to just make the net, whatever is the difference, so between what their bought position is and the sold position. So what happens is that exchanges, they have a delivery notification period. So say for example, for a May contract, the delivery notification period would expect it to start sometime in April. So so before April, you don't have any liability to deliver or not deliver, even though it might be a deliverable contract. So, but once the delivery notice period starts, then you can be assigned a delivery for the position that you're trading into. So now that we have understood the key characteristics of futures, now let's see why actually to trade futures. So as we saw that one of the best part about trading futures is that you don't have to pay in full. You can just pay the margin and trade. So which means that for the same amount of money, say if I was into the cash market or the physical market, then I would have to pay $150,000 to buy 100 ounces. But here I'm just paying, say at 8% margin, I'm just paying $12,000. So which means in case if I make 1% profit, so if the gold prices go up by 1% from 1450 to 4.5, in that case, I would have made just 1% if I was in cash market, but over here, I'm almost making 12% or 14%, right? Because I've just paid in 8% of the money and I've got 1%. So that's basically the leverage that I'm getting. So that's the capital efficiency. So, so by trading futures, you can take bigger positions by paying less as compared to in case of cash markets or physical markets. Then you have so many different characteristics of futures, which ensures that there are certain anomalies and different ways of trading. So you have more different kind of strategies that we'll be discussing in a bit, but you have different kind of strategies that you can implement for futures as compared to, say, if you were doing for a cash market where you can possibly just buy or sell or some strategies like that. And also, it also helps in terms of for, say, genuine hedgers who want to hedge their positions. If you don't have a warehousing facility and you want to buy, say, palm oil, you need a delivery of palm oil 3 months down the line. But you don't have like enough place to store say 100 metric tons of palm oil in your warehouse. So you can just buy a future, hedge your position, and for a 3-month expiry period future, and you can take the delivery when the future gets expiring. So thereby helping you in in better operations of your business. Then you have better liquidity. So most of you, if you have traded into cash markets, you would have seen that if you want to trade into big quantities, once you place the order, the liquidity is not very high, because you see that what you have is that the cash, since the lot size is just one for a cash market, so it could be the top 5 prices might be one stock, 1 share, 2 share, 3 share, 5 share, 10 shares, right? So in case if you want to go and buy 1,000 shares, it might be a challenge to do that. But in case of a future, since it has higher lot sizes, so even one lot would mean, say, if the contract size of 100 shares, then you just need to buy 10 lots rather than looking for the depth of 1,000 shares. So typically, if you want to trade into big sizes, then you see better liquidity in the futures market as compared to the cash market. Then the price discovery, fair and transparent price discovery at different periods of time. So cash is just giving you what price is as of today, but it is not providing you what price it should be 2 months down the line or 3 months down the line. So you have a better price discovery, and you can get a view of where the prices are heading for the cash market by looking at the prices of the future. All right. So the next is the futures pricing. So how do we price futures? As we have already gone through most of the characteristics, so I think this should be fairly easy now. First is definitely the spot price. Of course, whatever the price is of the underlying, it will definitely impact what should be the price of future, right? So if the spot prices are high, then technically future prices should also be higher. And in case if it is going down, then future prices are also expected to go down. Date of expiry, that's just at what is the date on which the contract is expiring. Risk-free rate of return, this is the return that you will make if you put your money, not invest anywhere but just into risk-free government securities for the similar duration. Then this is the risk-free rate of return which you will be getting for that investment. So this is a crucial aspect of what the prices of the future should be, because you are blocking some money right now for expected payout later on. So this is more of your opportunity cost that you are paying for that position. Then the storage and delivery cost. So storage and delivery cost would be your, as I said, that if you want to buy palm oil right now, so if I am keeping that for delivery 3 months down the line, and I'm buying right now in terms of cash rather than buying a future, then I would be paying a certain storage cost. So storage cost would be the fee that I'm paying to the warehouse for keeping my block of palm oil, and then the delivery cost as well, because you have to ship that to the particular warehouse, which might be the same or which might be a different one as well. So that's our storage and delivery cost. And the last one is the convenience yield. So convenience yield is actually the price that we are willing to pay to rather hold an asset rather than in physical form, rather than keeping it on papers. So what we mean by that is, say if I am a refinery, and if I have palm oil, crude palm oil requirements for my refinery, so my output might be varying on a monthly or a weekly basis, depending on what is the supply that I need to make, what is the demand in the market. So if I have readily available the asset, then I can, if the prices are expected to go up, then I can immediately increase the production, because I already have that in my in the physical form. So I would not be impacted by what is the supply demand supply crunches in the market, say, because it is possible that when the expiry comes, the other party might default on expiry delivery, then you will have a problem. Although that normally doesn't happen, but still, that's a possibility. So, so that's the convenience yield from the business point of view. So we call that the consumer. This is applicable for the consumer items, so which are made for consumer usage. Another one would be the investable items, say for example gold and all. So you will see a lot of people, especially in India, you will have a lot of housewives who will hoard a lot of jewelry with them because it's a symbol of prestige. So the symbol of prestige would not come from holding a paper bond which says that you own 100 ounces of gold, but from actually owning that jewelry or owning that gold. So, so that is also linked to convenience yield, typically more applicable for the investable assets. So, a little math here. So the equity futures, in this case, you don't have any delivery, any convenience yield. There's nothing. Everything is on paper anyways. So the future price for equity future or for an index future would be the, here your future ft comma t means that price of the future at time t, say time t or date t, that may be today as of now, and with the expiry on time t, capital T. So, so that would mean that the future, the current price of the future, if t is current right now, and say the expiry is May, so which is almost say 3 months. So, so the capital T would be a 3 months. So current price of the future expiring in 3 months would be equal to your spot price, current spot price, multiplied by e to the power rt minus t. So this part, e to the power rt minus t, this is nothing but the return that you would have got by putting that money into a government deposit, right? So this is the opportunity cost that you're taking. So if you are taking that to buy equity futures, you will expect that at least that much amount you will be making. So e to the power rt minus t, that's nothing but just the return. Okay, so this could have been very well could have been your 1 plus r, but where r is your return if r is very small. But this is more technically accurate formula. So so which just means that for the if you are assuming continuous compounding, then this should be your return. All right, so our risk-free rate of return that we have already seen. So that's the simple formula. So this is the expected price of a equity future or index future. In case of commodity, it's slightly more complicated. So in terms of like here we can see that we don't just have R to play the role, that is the risk rate of return, but also the storage cost and the convenience yield. So all these numbers are in terms of percentages. So what it means is that the spot price of the future at a time t expiring at time capital T would be the spot price of the commodity multiplied by the return that you would have made by using that money, adjusted for the storage cost, which is S, and the convenience yield. So which is, we are reducing the convenience yield because that is the price you're willing to pay. You would not have made that price, but that is the price that you would have been willing to pay for holding that asset in physical form. Okay. So is that any questions on this? Anything for the futures pricing, commodity or equity? Great. Yeah, sure. Yeah, sure. So convenience yield. Okay, so convenience yield, as I said, that it's the price that you're willing to pay to hold that asset in your possession, physical possession. Okay, so so say if the price is going on at $1,500 for gold, okay, per ounce, but you're willing to pay $5 just to make sure that it's available with you, it's with you. Okay, so in case the convenience yield, this is basically comes from the perspective of rational investor. So what we say is that all human beings are rational, and especially those who are playing in stock markets are rational, which is typically not the case, but still. So, so what we have is that it is assumed that if you are rational and you are willing to take a view on the market, that okay, just from the perspective of forget everything, but just that you expect the prices to go up, and you have an inventory lineup as in your factory, and you would need that much inventory in your place, and you feel that the physical supply would be dampening in the coming months. So you are willing to pay a premium to just hold that and make profit from it later on when the prices go up. Okay, so till the time C is less than R plus S, so which is the risk-free rate of return and the storage cost, the future prices are expected to be higher than the spot prices, which we say that the asset is into a contango market. And if the C is more than R plus S, so that is the convenience yield is more than the risk-free rate of return and the storage cost, in that case we would expect the future prices to be less than stock prices, which we call a backwardation market, where the future prices are less than the spot prices. I hope that clears. Yeah, okay, cool. So the strategies that we will be discussing a bit about would be the cash future strategy, the spreads, trading spreads, the index arbitrage, directional trading strategies, and the options hedge. So we will we'll go through them briefly, given the time that we have, but we'll try to understand the concepts as much as possible for each of the strategies. So cash future strategy. So cash future arbitrage is nothing but where you try to make profit by trading into cash as well as future in opposite directions. So in case the future is trading at a premium, and say for example the prices are going above the range that we are saying that okay, it is S into e to power RT, that just means that the prices are the price movement will give me that much return only, which I will get from the government security. So in case if it is higher than that, then it would make sense for me to make higher profit to sell the future and buy the cash, right? So that is what we call cash future arbitrage. Now, an interesting part in this is that long cash, short future, that you can do almost anywhere in any of the exchange in any of the countries. But if you want to do short cash and long future, there are other rules which comes into the picture. So which is that whether the shorts are allowed in the market or not, whether they do have a SLBS market, sending and lending and borrowing scheme, so something of that sort present in the market. So because you do, when you're shorting, you don't own that stock, right? So if you want to go short, some exchanges allow, some doesn't, and even though for those who are allowing, you will have to make delivery sometime for the stocks, for the shorts that you are making. In case of futures, there is just a net settlement, so it doesn't matter. But in case of cash market, that's there might be delivery which might be involved. So you need to have access to that mechanism. So that's the top thing that you will keep in mind while trading while doing a cash future arbitrage, that whether the short are allowed in the market or not. Second is obviously how much premium are you getting. If you're getting enough premium by shorting the future and buying the cash, which is beyond the risk rate of return, then by all means you should go for that, because at the expiry the cash would be the future, or the future would be the cash, right? Because on expiry date the future, if you remember FT comma T, so both T are the same on expiry, right? So that is fine, but short cash, long future, you should not get excited for on seeing very high returns, much higher than risk rate of return by shorting cash and long future, because you might have it might just be because case 1 shorting is not allowed, case 2 shorting is allowed but the delivery mechanism is not in place, case 3 not many people have access to the delivery mechanism. So in that case you might see even for a month expiry, 10% returns that you might get by shorting the cash and going long on future, but you're not really getting it because you cannot do it. That's why it's there. Okay, and then the second thing is that since this involves both the future market as well as cash market, and you have to take position at the same time for both the future as well as cash. So which means that you should have enough liquidity in the cash market for the stocks that you're planning to go long into. Okay, because if you have delay and if you are putting your order which is standing in the market, then you might see some slippage because the prices will move by the time your order is getting filled, and then you might have an issue there. So that's why I always go for the liquid counters. So in case of whether it be stock or the commodity, in case the spot market for commodity is available. Then the third thing is that the spreads typically tend to be more volatile when it is close to expiry. This normally happens because of, first thing is that obviously time is very, let's say on the expiry day, the T is 0, right? So there is no return that you're making on that in the risk-free rate of any risk-free rate of return. So whatever deviation it is, deviation. So that is one thing. Second is that in case there is a delivery for the future, it's a deliverable asset, the delivery mechanism will come into the play. How much stock is available in the warehouses for delivery, how much is not. Depending on that, spreads can go haywire. So that's why it should be the spreads at the expiry, that should be taken with a pinch of salt. Then this one is more obvious, that if you move into a economy or a market where the interest rates are much higher, then the spreads are expected to be higher. That's simply coming from that formula only, where you have higher risk, higher opportunity cost for letting go your investment in your government security and actually investing in the stock future. Then the market sentiment. This is something that plays a big role, especially when you have when there is high volatility. Say on the days when there is some announcement which is being done by the Fed or some gold exchange the government inventory, gold inventory, then you will see that the prices at that particular point of time can move by 2%, 3%, 5% within a matter of seconds to minutes, right? So at that point of time, the thing that matters more than the spreads is what is the market sentiment. Because if the market sentiment is that, okay, this has come and now it is bound to go up in the next few minutes, then people might be willing to pay a premium to buy that future rather than not buying it at all just because it is expensive. So that's more of a demand supply thing, equilibrium thing, but normally you will only see it when the market is very, very volatile. So that's about cash future. Second is on the spreads. So spreads, you have different kind of strategies that you can do in spreads. First is, of course, the calendar spreads, in which what you're doing is that you're just taking a near month contract and a later month contract and playing the difference between the two. So the key benefit of trading into spreads is that they are not that volatile. You do not need to post much margin because the exchanges provide you to this calendar spread benefit, because exchanges also understand that the spot risk is eliminated in case of calendar spreads, because you are selling and buying equivalent amount of spot at different future dates. So the only margin that needs to be taken care of or that needs to be charged by the exchange would just be your the expectation of price difference between the two dates. And when I say price difference, not really of the spot prices, but more of what is the opportunity cost again, in terms of the risk rate of return as well as your storage cost and other things. So in calendar spreads, it's relatively quite easy. What you can even do is that most of the tools, trading tools which are available, they can create spreads for you directly and say the next month is at 1500, near month is at 1480. So the difference is just $20. So you are actually trading that asset class of $20. So exchanges also offer those products where you have calendar spreads, where you can trade calendar spreads directly. Otherwise, you can also create within your own trading system. So it's quite straightforward there. So yeah, and the returns obviously are, since they are less volatile, but the margin that you're placing is also much less. So returns are normally pretty good over here. Then this next is on intermarket spreads. So intermarket spread is that you are in the same exchange, but you are trading different asset classes. So one can be, say for this example, FCPO versus FKLI. So you are taking one from the commodity market and one from the equity market, that is the equity index future. So what you're doing is that you take these two instruments and see that if there is some correlation between these two things. So by correlation, I mean that does these things tend to move together? Say if the crude prices are, palm oil crude prices are going up, then should I expect the index to go up as well or go down as well? So why should that happen? This happens because all the markets are interconnected. In terms of various asset classes, be it your commodities or be it your equities or currencies or interest rate, there is a cycle which connects them all. So if there is any movement happening in one of the instruments, you expect some movement in the other other instrument as well. Now, would it be directly correlated or inversely correlated? That's a thing that only your analysis can tell you. Okay. Next is similarly, you can also have them in the within the same asset class. So say crude palm oil vis-a-vis your gold. So between them also you can play that, okay, if the crude prices are going up, gold prices are expected to go down or go up. So what does typically gold prices going up suggest? Typically they suggest that the market sentiment is not very good. The people are not that bullish. Normally it goes reverse also at times, but in most of the cases that's what the economic fundamental is, at least, that the gold prices are going up because the market sentiment is not good. The inflation might be there, it's a hedge against inflation, and it's a safe asset, it will be there forever. So that's the idea, but that also means that you are bullish there because you are bearish on the markets. So in case of the first example, you could have actually shorted the KLI index and gone long on the FCPO. Oh, sorry, if it was FGLD versus FKLI. Similarly over here also, if the markets are not looking good, that means that the economic activity is going to dampen a bit, which means that the production is going to go down, and which means that your the demand for the crude palm oil, that's also expected to go down. Right, so that's why you can play this pair as well. Obviously, this is the fundamental, but how much you can do it, that depends on when you run a analysis on the prices of the two different instruments. Then you get to know that, okay, is this worthwhile to do or not? That's a quant perspective, but if you are a fundamental player, then of course you can, just by looking at the fundamentals and what are the news and what are the things happening. So based on that also you can take a position. Then there is something called inter-exchange spreads. So inter-exchange spreads can be your pure arbitrages, so, or classic arbitrage, in which you are buying and selling the same instrument in different exchanges. So say in case of BMD gold versus CME gold. But it can also be statistical arbitrage, where the underlying asset class is not exactly the same, but similar. So so you do that. You say that, okay, I expect to make money by buying this and selling this, even though they are not exactly the same thing, but they are highly linked to each other, and for all practical purposes of mine, they look same to me. So that the classic example would be BMD palm olein versus